Thank you so much for coming this morning. For those of you who have not been to Gaucho before, the company's been around for 22 years now.
So us in Richmond, we are, as you can see, award-winning from, but in a nutshell, so we are a telecoms company. So we provide telephone systems, be them on-site, so a bit of tin whirring away in a corner, or a cloud system, which most people move to today due to the widespread access to good internet means that you now can just push all your business services into the cloud. So we provide that. And we do everything else around it, including those business internet lines. And as I mentioned earlier, as good as our technology is, it's the people in the business that really make it work. So the full professional services portfolio, the account management, the customer services, the complete wraparound is what makes us stand out from the crowd, I shall say, in our competition. People like BT and Gamma and the big corporates out there, which we're incredibly proud to be seen on a level. We're a small business based in Richmond, and we're absolutely fighting day in, day out with BT to make sure we deliver a much better service, and we win a lot of business off them, so we're proud to be doing so.
My name's Tim Bond. I'm a partner at OD Asset Management, and I'm a hedge fund manager and a sort of empirical economist, I suppose would be the best description. Probably right now, I'm one very scared hedge fund manager. I'm more nervous about the outlook for global growth, I think, than I've been at any point, probably in my career, and that includes, 2007. What is a business cycle? And a business cycle, in my book, really is just simply a reflection of oscillations in human psychology between, over-enthusiasm and over-pessimism. And typically what happens in a business cycle is people in the up part of it, people get very excited, very enthusiastic about the future, they get too bullish, and they overinvest. They overinvest in houses or whatever happens to be the fad du jour. It's usually property, but it can quite often be something else. So people get over their skis, is the phrase that they use in America. They get in over their skis. They get overcommitted, and they build up too much capacity, and they're too bullish about the future. And then, whatever it is, some shock or just simply the law of gravity kicks in, and then everybody runs to the other side of the ship, and then we get a recession. And that's typically what goes on in a very simplified business cycle. So during the phase of exuberance, the central bank puts interest rates up, and during the phase of depression, they pull interest rates down. So that's been the pattern that we're all familiar with. Now, obviously, we've got a problem here because interest rates, have hit the zero boundary. And in fact, in quite a few countries, they're going slightly below the zero boundary. And economists the establishment continues to assure us that monetary policy still has plenty of room to intervene against any possible cyclical downturn. In other words, we've hit the zero boundary, but we can go through that. We can take rates deeply into negative territory if we want. We can intervene in asset markets. We can pump money into the system using quantitative easing. I think the big point that really needs to be understood is they're not going to work. And in fact, it's now becoming very evident that a lot of these policies are very counterproductive. We've hit the point where central bankers are pushing deposit rates into negative territory. That is, you get fined if you leave your money in a bank. You get fined if you're a saver. Now, surely there is some logic here that might seep into the academic economic mind that if you've got to the point where you're trying to fine people into increasing their consumption to some supposed correct level of demand, that there might not be something wrong with the demand side of the economy, it actually might be something wrong with the supply side. In other words, too much supply rather than not enough demand. So the net result of all of these policies is that you are essentially killing your banking system because you're removing its ability to make any money. You're crushing their margins, and that's all that happens. Which means, if in a system that is dependent on bank credit, you've reached the limit to which monetary policy can ease. There is no further ability to be able to stimulate the economy via monetary policy. You can buy all the government bonds, you can buy all the equities, you can buy all the corporate bonds you want and boost your balance sheet, the central bank, but it will just kill your banking system and therefore have a counterproductive effect. So certainly in terms of monetary policy, we've hit the limit. And that's why I'm one very scared hedge fund manager because I can see the world heading into a cyclical downturn that could possibly be quite severe, and I'll come on to talk about why that's the case, and we're sort of going into it naked. We don't have any protection. So unlike 2007, 2008, when it was quite clear that the banking system was around the world was severely challenged, we had lots of policy tools that we could apply, and that were applied generally, fairly successfully. This time around, we don't have that luxury. So for the first time in any living person's memory, we are going into a cyclical downturn without any ability, for the central banks at least, to weigh against this. So China is certainly changing, and we can see a lot of the repercussions of that already, and to some extent, what's been going on there has already slowed global growth. However, things are a bit more complicated than that, because China is, again to use that phrase, has been way over its skis, the end of its skis, for about a decade now. And China is a place where you have an extremely large accumulation of bad debt sitting in the banking system. You have a vast amount of overcapacity in a very wide variety of industries. And there is very little that the government can really do to deal with this problem effectively. In other words, at some point or other, we're going to have a very large drop in the Chinese economy as all these various chickens come home to roost. And China, again, is somewhere where the policy tools with which they've driven the economy for many years, those policy tools are no longer effective. During the financial crisis, the Chinese government panicked and sort of pressed the lend at all costs button. And there was a huge surge in lending. So bank debt, or bank lending, relative to GDP, went up 100 points, 100 percentage points of GDP from 2007 through to the end of last year. That's a massive increase in lending, extremely fast. And yes, it certainly played a role in dragging the global economy out of the near depression caused by the financial crisis. But it also meant a huge accumulation of bad debt on Chinese bank balance sheets. There's a thing called the credit multiplier, which we talk about in the markets, which is really simply the ratio of lending versus the amount of GDP that's created by that lending. Now, it's a fairly unorthodox measure, but it's a simple measure. So how much money is lent in the economy? How much do you get back in terms of GDP growth? Well, prior to the financial crisis in China, typically $2 of lending will get you $1 of GDP growth. So that doesn't sound great, but it's okay, and that ratio was pretty static for a long time. At the end of last year, that ratio was now 6.6. In other words, it took $6.6 of lending to get $1 of GDP growth. In other words, the Chinese financial system has got so much bad debt, it's so bankrupt, that any kind of new lending immediately goes off to pay old lending or to service the existing stock of debt. So recently they announced they were going to cut something like, I think, 15% of their steel making capacity over the next 5 years, and they were going to lay off 2 or 3 million workers. Which sounds, wow, that sounds Austrian, that sounds, the Germans would do this is the way to run an economy. Actually, it turns out that their excess steel capacity that's not being used at the moment and hasn't been used for 5 years is 25%. So they're cutting just over half of the excess capacity, and it still leaves them with a vast amount of excess capacity. You get the idea. Turning to the US kind of looks okay. The growth has been pretty good. It's been uneven, but generally, you've trended a little bit over 2% in real terms, and the economy has generated a lot of jobs. Unemployment is very low. The government deficit is pretty small. It looks like an economy that's in reasonable good shape, and indeed, recently we've begun to see a couple of indications that inflation might be starting to recover there. Is that the business sector, for pretty much the third cycle in a row, has borrowed far too much money to buy back its own equity. Most other countries in the world, we are seeing a trend in which productivity growth is remarkably low. I mean, extraordinarily low, and it keeps on getting lower. Now, no one has got a good explanation or for why this is occurring. There's multiple explanations, and it's a very complicated subject, and I'm not going to go into it here. But the big point is that the output per hour continues to slip and to slow. So that's a kind of secular trend for whatever reason. So you have a banking system with a stock of bad debt, hasn't really been dealt with. They depend on having positive growth to deal with that. When you don't have positive growth, you have this horrible negative multiplier that then comes into work where the banks worry about their debt and their capital positions. The central bank starts to make it worse with poorly thought out policies. And suddenly you're back into that hole you were in 2011, 2012, where nobody wanted to lend anybody else a dime, across Europe. The strong lady who's kept it all together for, through the Eurozone crisis is politically damaged. The Brits threatening to pull out of the whole system as well. So it's a politically fragmented system. You have a central bank that no longer is able to really get any traction on the economy, and when it does, it's the wrong sort of traction. And you have this sort of landmine that's still sitting there in the banking system.
I wondered why Anne had invited me to come here today when you had such a fantastic speaker, and I now see why, because you will all go out that door and drown yourselves in the river, unless I do something now to go ahead and cheer you up. But I do want to say, we don't have to commit harikiri at this point, I think, and sit on the brink and say we're about to head into a massive depression and there is nothing that we can do to try and deal with our issues locally. So abandon your business, go on holidays, sell your savings, enjoy your savings and disappear. There clearly is a mechanism, there clearly are mechanisms available to begin to tamper the risks that we deal with, but it will always be within the context of a risky world. In the last quarter of 2015, if you look at new lending to British businesses, the third largest lender was Funding Circle. Funding Circle, a peer-to-peer platform, it did not exist 5 years ago. That's on every front, you are seeing the new players coming into the market. They're not stuck with the legacy technology of the banks. They're not stuck with banking culture, and they're not stuck with large banking bureaucracies. They are coming in and using the new technologies offered by the internet to be able to deliver services very specifically, very directly. And more small businesses now don't even bother to walk into their bank if they want to raise funds. They start looking at the various different platforms that are out there who will turn around the response far more quickly, and who frequently are far better priced, and they will look at using those kinds of mechanisms. So you're seeing this disintermediation. If you're in the hotel industry, Airbnb is a damn worry. There's a company that doesn't own a single asset and hardly has an employee, and it is now the fastest growing provider of places to stay for people going travelling. I mean, you can repeat this over and over. So in all of services, you're seeing this massive disintermediation. And I think it's brilliant and very exciting. We don't know how to regulate it, we don't know how to tax it, but it is very exciting and has huge potential because it decentralizes opportunity and democratizes it in so many ways. Even in really conventional ways, there is huge change coming. But how do you survive and thrive in this world? You have got to be skilled. And that is an area where we have a huge opportunity to make a difference, and that hits all of the productivity buttons. And it's obviously back in schools. Lifelong learning genuinely has to become something that we do. People are going to have to think in terms of constantly upskilling and constantly skill shifting to take advantage of the job opportunities that will come. I've also talked to a lot of small businesses. I'm very pleased that the government yesterday cut the business rate for small businesses. They're absolutely vital and necessary because people were getting into an awful bind, frankly, as rising property prices were just pushing their rates up on a constant basis. But one of the effects of living with that very high business rate environment is an awful lot of small businesses have looked at automating more and more of what they do and not actually hiring people. And you can look at a pattern that sees what you think of as routine jobs just seriously beginning to disappear out of the economy. So on the productivity front, we have to focus on skills, I think, on a scale and over lifetimes in a way that we frankly never have. And in terms of infrastructure, we have to give absolute priority to getting infrastructure very rapidly in place so that we can compete. Because the forces that are coming at us that are going to be difficult, we can't control them. We're a medium-sized economy, and there are a lot of very big, massive economies that surround us and dictate the total environment. We've got to have a way of managing that back, and I think focusing on getting productivity up is probably the most powerful tool that we've got. But to me, that's a hopeful message and not a reason to go and jump in the river.